Welcome to Daily Market Reflection for the June 23, 2026 close. The central tension is simple. The tech-heavy tape feels heavy, and semiconductor names are clearly cooling, but the broader risk dashboard does not confirm a systemic panic. QQQ is down more than 4% over 5 sessions, while VIX is still below 20 and credit proxies are not breaking down. That combination argues for caution, but not for crash language. Today, we frame the market as tech digestion versus broad market rotation. Before discussing individual tickers, we classify the regime. The cleanest label is a choppy pullback after a main uptrend. Momentum is cooling and leadership needs repair, but the evidence does not yet support a full risk-off exit from equities. The practical implication is to avoid all-in and all-out behavior. A pullback is not automatically a crash, and the first bounce after weakness is not automatically a confirmed reversal. The macro backdrop has one clear pressure point: the dollar. The dollar index is at 101.41, up 1.79% over 5 days and 2.53% over 5 weeks. That is the strongest stress flag in the dashboard. The 10-year yield, however, is not the main problem today. It sits at 4.493%, only about 1 basis point higher over 5 days. Retail sentiment is cautious, with the AII bull-bear spread slightly negative. The next major macro date on this watch list is the July 14th CPI release. Index structure shows pressure, but also clear reference points. SPY is down 2.82% over 5 days. QQQ is weaker, down 4.08% over 5 days. QQQ closed at 713.65, below its daily 20 EMA at 722.14, but still above its 50 EMA at 697.36. That means the short-term trend needs repair, but the medium-term structure has not fully failed. The rotation snapshot is the reason we do not call this a broad exit from equities. Over 5 days, IWM is slightly positive and XLF is up 0.6%, even while QQQ and XLK are down about 4%. Over 5 weeks, financials are up 4.46% and semiconductors are still up 3.86%. This is a market where money is changing location inside equities, not one where everything is being sold at once. The risk dashboard says mild stress. VIX is 19.49, up over 5 days, but still below the 20 threshold that often marks a more urgent volatility regime. Total put call is 0.92, and equity put call is 0.60, which does not show panic hedging. The credit proxy using HYG versus LQD is softer but not breaking down. The dollar remains the main yellow to red flag. The dashboard supports monitoring confirmation, not declaring a crash. The AI and semiconductor watch list is where short-term pressure is most visible. SOXX is down about 4% over 5 days, while SOXL is down 15% because leverage magnifies the move. ARM and MRVL also show heavy short-term pressure. At the same time, many of these names are cooling from strong prior trends, not necessarily breaking their long-term thesis in one day. NVIDIA sitting near its weekly 20 EMA area is a key hold or reclaim test for the group. The right response depends on time horizon. Long-term investors should focus on thesis and weekly structure rather than reacting to one volatile session. Swing traders should wait for support reclaims, improving momentum, or a stronger volume-backed bounce. Intraday traders should be careful with chaotic openings and leveraged products. The same candle can mean different things for different horizons. Confirmation matters more than prediction. A good plan keeps both exposure and cash. Exposure allows participation if the market stabilizes. Cash creates optionality if the pullback deepens. The cleaner add zones come near support or after stabilization, not after an emotional chase. If a rebound reaches resistance on weak volume, swing risk can be trimmed without abandoning a core thesis. The analysis changes only if weakness broadens, credit deteriorates, volatility accelerates, and key index supports fail to reclaim. The base case is choppy digestion after a strong trend. The bull case requires QQQ to hold its 50 EMA area, semiconductors to stabilize, VIX to cool, and the dollar to stop accelerating. The bear case requires a broader breakdown. QQQ and semiconductors losing support on volume, small caps and financials losing resilience, credit worsening, and volatility rising. Bottom line, this is not yet a crash script. It is technology and AI leadership digestion with rotation underneath. This is market commentary and educational content only, not financial advice.